if the S&P is comfortable with Hyperliquid, that is opening the door for all institutions to start trading on Hyperliquid and to get comfortable with Hyperliquid.
CLIG is out effectively saying perpetual futures are coming. I do think it's a really meaningful shift into a 24/7, 365 world. It's not trivially easy, and I think it's a generational opportunity for new crypto platforms like Hyperliquid to step into that and become really dominant in these new markets.
So the SEC created a taxonomy of 5 categories of crypto assets, each with distinct legal treatment. That is a huge clarification that we've all been asking for.
This interpretive guidance is coming from both the SEC and the CFTC, but this doesn't carry the same force of legislation. This is guidance.
Everyone, welcome back to another episode of Inflection Podcast. Before I begin, I want to please note that none of the information discussed constitutes investment advice or an offer, recommendation, or solicitation by Blockworks, Galaxy, Bitwise, Anchorage, or any of its affiliates to buy or sell any securities. So with that out of the way, let's jump into it. We have some topics that we wanted to cover this week, a lot of big news. But first, I just learned, you can, if for the viewers at home, those who don't do audio only, Dave is at a hotel, and that's because he's at a conference in Brazil. And I think there were some interesting takeaways from it, David.
I am, yeah. I'm at a stablecoin / crypto banking conference in Brazil. I love being here. It's my country of origin. I think maybe we should do an episode on that one day, but I think the Brazilian crypto market is a little bit overlooked, especially in the US. The thing here is that the Brazilian financial market and the banking system are extremely well developed. The Brazilian banks are huge, and they're known for being one of the best run banks in the world. They're known for that. And Brazilians are usually pretty early adopters of technology. And crypto has been no different. I think if you talk to anyone about crypto adoption in emerging markets, everybody will get that. But the part that people miss is that there's a massive crypto institutional market here in Brazil. I would say in LATAM as well, more broadly. But in Brazil, you have these giant banks like the JP Morgan of Brazil or the Goldman Sachs of Brazil. These guys are running some crypto strategies on their prop books. They are offering crypto access to clients. Some of them have built their custody solutions from the ground up. So it's really cool to see how much adoption and how kind of ahead. Of course, the US has been catching up a lot with the regulatory shift that we saw over the past year or so. But I feel like the Brazilian banks are kind of ahead even of some of their US peers. So it's been great to see. I mean, a lot of discussions around stable coins. That's definitely the main topic right now. There's banks and regulators and financial institutions from all of LATAM. Really good to see. I think it's a testament of how the institutional and banking crypto market, not only in Brazil, but in LATAM more generally, has been developing.
Yeah, for sure. I remember in 2022, Nubank, which is, for the viewers, a fintech, a large fintech in Brazil, they launched us. They were so early with it. They launched their own token, Nucoin. They tried to use it for loyalty points, and people thought maybe that was the way. That project was obviously canceled. And their last earnings report, they announced their stablecoin linked cards. I'm sure Nubank must have had some kind of presence at the conference there. And I know Mercado Libre, which is another big, is I kind of describe it as the Amazon and PayPal of Latin America. They also are playing in the crypto front, stablecoins, Mercado Pago. So yeah, definitely Brazil's ahead in terms of fintech.
100%, man. Nubank is probably one of the largest fintechs in the world. They're actually now opening a banking charter in the US. They're moving to the US. And they've built a very strong crypto team recently. They did some very big hires Michael Rihani from Coinbase, the guy who created the Coinbase card. He's at Nubank now. It's very, very strong team there.
They also had somebody from the Libra team join too, right? Libra, which is Meta's or Facebook back then's play of like a stable coin, so to speak. Yeah, I think like they're really pushing out their like crypto personnel and the US now with their bank charter, which is something we talked about last episode.
Right.
David, are you seeing beyond the hiring and the planning and the implementation, do you get a sense for the like actual on the ground real use of things like stablecoins there? Like how big is that? How significant of it is it still just a tiny little niche? Is it broadening out beyond crypto natives? Do you have any feel for that?
I actually think stablecoins are heavily used here, Matt. There is some data, and don't hold me to it because I'm just pulling this from memory. But the Brazilian IRS, they collect crypto transaction data, and something like 70 or 80% is stablecoins. Most of that is Tether. So stablecoins are used as a payment system for cross-border transactions, either B2B or B2C. So the usage is pretty extensive. There is one large bank, BTG Pactual. They're kind of the Goldman Sachs of Latin America. Now they've brought it up to retail more. This is not probably the best analogy, but that bank launched a stable coin in Brazil quite a few years ago. So it's been pretty interesting to see. And there's definitely adoption as a payment system. Of course, there's the trading side of it, but as a payment system, it's definitely used. In other Latin American countries, I would say it's even more. One thing I heard is that I think in Colombia, you're going to see like typical consumer goods like a car being quoted in local currency and in USDT. It's not even quoted in dollars. It's quoted straight in USDT, which I guess it's also a testament of how much adoption we're seeing.
Amazing.
I saw a picture on Twitter too in El Salvador in the airport, like grocery or duty free, like same thing. It was priced in the local currency, and then also the tether sign, which is like I don't know. I saw it long ago enough that I don't think it was an AI generated image, so I believe it. But these days, you never know.
David, was there any indication of what chains they favor in Brazil? It's always amazing to me, sitting in the U.S., how much Tron is slept on in Asia, right? From the U.S. perspective. I mean, when you look at stablecoin flows globally, Tron is doing a tremendous amount of work through USDT. And like, I will just tell you, like at Galaxy, we don't talk about Tron that often, right? Like, this is not something that comes up. I'd be surprised if Anchorage or Bitwise was any different. And I think that's like maybe something that is just built in the sort of the culture now of some of these Asian countries. I was wondering, in Brazil, is there any sort of favoritism there to a particular chain?
It's a good question, man. I'll probably need to dig deeper, but I do see the main chains, the ones that we are used to. So like Ethereum and Solana. One that I probably see more in Brazil than in the US is Polygon. We were just talking about Polygon before we started recording here. I probably see Polygon a little more, but it's definitely not the prevalence of Tron that, I hear a lot in Asia, maybe even more as a trading instrument than as a payments tool. But I'm not familiar with Tron being that much used in LATAM.
It's really remarkable. I mean, I was looking at the Blockworks data page, which shows the average transaction fee, and it looked like an advertisement for Tron because the average transaction fee was like 0.01, like a penny or maybe a tenth of a penny. And then Tron was like 8 zeros and a 1. If I had been working at Tron, I would have just captured that and shared that all over social. I just looked now and it's actually zeroed. Which means it's actually rounding down. So, I mean, there's a reason it's so popular, Mike, right? It's like super cheap, and the people have trust in it, and therefore they've gone that way.
What's interesting from the DeFi perspective, though, Matt, is like they really haven't built out much of the DeFi infrastructure on Tron that you would expect given all of the stablecoin and payments flows, right? Like I could look it up right now, but if you look at like the top dexes on Tron, they've got like 200 million of volume, right? Like almost nothing, a daily volume. So that is a big question in my mind about Tron, and And I do actually think it's used largely as a payments platform, but it's interesting.
I think that might be almost on purpose, because if you start to have DEX volumes, then you start to have competing block space, and then that's what ends up driving up the price. But a stablecoin transfer doesn't matter if it takes half a second, 1 second, 3 seconds. The users are willing to wait, and that's why the fees are so low. I mean, and even though the fees are so low, David and I were talking about payment chains before. Like Tron is consistently in the top 3 or 4 chains by fees across all chains, even with though and a vast majority of it is payments, and even as low as Matt said, X number of zeros before the cent. So they're doing a ton in volume.
Yeah. I mean, that's a great point, Mark. I will just add, though, that this is a solved problem on other blockchains. So, for example, on Solana partitions block space based on the accounts that you touch. So if you are sending a transaction for just a payments transaction, you're not competing against an NFT launch or a DEX transaction or any other sort of borrow lend protocol. It is completely separate. Now it will still sit in the same block space, but it will not compete for transaction fees with others. So I do think, though, that like Solana is pretty advanced in that sense. On the EVM side, which I think Tron is definitely a fork of Ethereum, you're right. That is a consistent problem. And it's been a problem on Ethereum as well.
Yeah, I would just note one thing that you learn from this, which I think crypto mistakes all the time, is that brand and familiarity and stickiness matter a lot more than people think. I feel like because they're all techno crypto geeks on crypto Twitter, they're like pushing for the lowest available cost and the most. People just get stuck on what they're doing. I think there is real brand moat consistency in crypto, which I actually think is important ultimately to the valuation of these tokens, because I think that's where some of the non-commoditized pricing will come from. That there is this stickiness of users, which is real, right? It's not all subject to sort of like sushi swap style attacks that vampire it out instantly. There is more brand consistency, and I think that will grow as crypto matures. I think that brand comfort will become more and more valuable, and is one of the reasons I don't ultimately think block space will be fully commoditized.
I mean, that's a great point, Matt.
Among investors. I'm sorry. When I talk to our investors, like if you talk to an Asian investor, you're going to see a lot more interest on things like BNB. While you talk to US investors, you're probably going to see other things. I think this home bias has reduced a little bit, but it's still quite persistent, and I think it speaks to a little bit of that too.
Yeah, I was going to add to that on Hyperliquid. That is probably Hyperliquid's most powerful asset, is its brand. Hyperliquid users are vehemently loyal to Hyperliquid, and it doesn't seem like, even if someone comes out with a better perp dex, that they're going to lose market share, because Hyperliquid users have been on Hyperliquid from the beginning. It doesn't hurt from the fact that Hyperliquid made a lot of their early users quite wealthy, right? Hyperliquid had a very, very interesting business model. It didn't take VC funding. And I think that is an underreported story. In the trenches, you'll hear it all the time, but like in the big news, you don't hear this that often. But Hyperliquid didn't take VC funding and therefore didn't have VC token unlocks. Instead, it was self-funded, thereby, I think, increasing brand loyalty and trust from users. And on top of that, what it did was it airdropped Hype token to its users in proportion to how much they use the protocol. And when Hype went up in value, all of those users got made a lot of money. And that actually created a network effect that is persisting to this day. And now you've got an army of Hyperliquid users out there that have made a lot of money on Hyperliquid, hold Hype still, and are constantly promoting the venue. So it's really interesting.
They just got an additional lock with licensed S&P futures. We can talk about that later.
Yeah.
But I think that's quite interesting.
They're going to be a giant.
No, let's talk about it now. Like that's big news for Hyperliquid. I mean, it's a gateway, like permission almost, for the institutions to now trade this S&P, which many other crypto natives have been doing on perpetual futures on Hyperliquid. And last episode maybe I talked about how I love that there's other instruments coming out to trade on a weekend now, and that's not just Bitcoin. So a lot of the volatility can be distributed to other assets. So yeah, love to get your takes on this. What does this mean?
I've got an interesting take, I think. If you bear with me for a second. So on the surface, the headline is simple, right? The S&P 500 has been licensed for a perpetual product on Hyperliquid. That means a 24/7 on-chain officially licensed S&P 500 perp. And obviously that's bullish for Hyperliquid. But that is not the real story, I think. I think the real story is what this seems to imply for institutional adoption of Hyperliquid. Because if you and why that matters actually is because Hyperliquid for retail is one of the most exciting products in crypto. But it is not by any measure a pristine model of decentralization, right? The code base is closed source. The validator set is 25. The Hyperliquid team has enormous control over Hyperliquid. And maybe that will change over time. Maybe this is just early, but it's not decentralized by any stretch of the imagination when you compare it to Ethereum or Solana or even Tron or BSC. But that matters because Hyperliquid's core product is perps. And perps have historically lived in this very gray area. They've had to be offshore. They've had to be geofenced from the US. They've had to operate outside traditional US regulatory perimeters. And so that has been sort of the status quo, right? If you're going to have a perps exchange, it's got to be offshore, and it's got to bear on crypto perps, and it can't target U.S. persons, because if it does target U.S. persons, the CFTC has very strict rules against perps, right? Perps are illegal in the U.S. They're considered a future, and futures without an expiry are illegal under the U.S. So that's sort of the background here. But it all is even more difficult for Hyperliquid on paper when you think about equity perps. I called equity perps in a tweet a couple months ago the holy grail of regulation, right? You're regulated as a security-based swap under the SEC. You're regulated as a future under the CFTC. Under the SEC, you can't trade security-based swaps unless it's on a nationally registered exchange. For the CFTC, it's even worse. You cannot trade futures unless you're registered to do so, unless you are a CEF, right? Unless you have all these different regulatory trappings. So on both sides here, the SEC and the CFTC, equity-based perps are very, very risky from an institutional perspective. And yet the S&P knows all of this, right? The S&P understands this dynamic and supports this and is putting its flagship equity index, it's that huge stamp of approval on this product. And I think that is tremendous. And it means either one of two things. Either S&P just doesn't care, and they're just saying, oh yeah, we're just an index license. It's a licensing deal. I don't think anyone believes that, right? The S&P is very sensitive about how it safeguards its brand and its reputation. Very sensitive. Or the alternative is they understand the risks. They understand that this is a very touchy area for crypto regulation, and they're doing it anyway because they've gotten comfortable with Hyperliquid. And if the S&P is comfortable with Hyperliquid, that is opening the door for all institutions to start trading on Hyperliquid and to get comfortable with Hyperliquid. So it's a more nuanced take, but I think that is an astounding development for Hyperliquid. And I think it's going to be we have to see where this product goes, but it's probably the most bullish news for Hyperliquid since Hyperliquid was founded.
Yeah, I agree with that. I mean, I'll maybe add my own view of the context of the decision. I think it's a meaningful step that S&P said it was okay. I do think that really opens the door, as you're suggesting, Mike. I think there's this financial development framework in the US right now, which is that regulators say something can exist, and then you build it and you make lots of money. As an example, they said, let there be super apps. And now everyone is building super apps and they're being rewarded in the marketplace. I think something similar is true here, right? The CFTC allowed Coinbase to self-certify perpetual futures last year. And then CLIG is out effectively saying perpetual futures are coming, right? Like, so they're the tea leaves are there that this is going to be okay. And I think S&P is front running it. I do think it's a really meaningful shift into a 24/7, 365 world. I don't think people understand how difficult it will be for the existing system to go 24/7, 365. I think a lot of people are like, well, CME will just go 24/7, or NASDAQ will just go 24/7. But you can't really pull that thread. There's so many things that collapse if these people try to go from markets that close to markets that never close. It's not trivially easy. And I think it's a generational opportunity for new crypto platforms like Hyperliquid to step into that and become really dominant in these new markets, because they cannot flip a switch. Like, the systems will break, margin requirements, broker requirements, maintenance, etc. It's all set up to have these breaks. They're not there because people want to take nights and weekends. They're there for very complex reasons. And so it's this huge opportunity for Hyperliquid. I think it's really significant.
Strong agree with both Michael and Matt. This adds a lot in terms of like regulatory standing and perception. And I would add on top of that is that it makes Hyperliquid more efficient than others as a trading venue, because there's a whole perception and regulatory standing side. But the other thing is that when you are sourcing a perp straight coming from the S&P data feed, you can potentially be more efficient, especially during times of volatility, versus other, because there are other S&P perps out there in the market. They're not licensed, which means that they're either relying on oracles or they are relying on third-party kind of proxy price aggregators or something like that. For a lot of investors, this is not going to make a lot of difference. But for some, especially for the professional ones, the ones that are doing complex arbitrage, the ones that are doing basis trading, and this is a lot of the volume in crypto and probably even in traditional markets. We sometimes forget that a lot of the volume is coming from delta neutral investors. So if you are one of those types of investor who are literally paying attention to basis points and these efficiencies, and you want to be close, you want to have a strong tracking even during times of volatility, that's, I think, is where operationally the licensed index comes. And that's kind of a lock for Hyperliquid, even compared to other venues within DeFi. So yeah, very positive, very excited to see that.
I just want to add one other thing here that I am a little confused about, and I would love to know what you guys think. Because, so, U.S. jurisdiction is universal for any U.S. security that affects U.S. markets. I don't think anyone can convince me that if this product takes off, it is not going to affect U.S. markets, right? And yet the geo-blocking wouldn't matter in this circumstance. The geo-blocking doesn't matter even if 100% of users are non-US and it is completely offshore. If it is trading something linked to U.S. securities that has an impact on U.S. security markets, the SEC will have jurisdiction. So that is a huge. I mean, I know every lawyer that the S&P talked to said the same thing, and yet they went with it anyway, which makes me think there is a potential change in regulatory posture that is going to happen beyond what just came out with the SEC. With the guidance that I'm sure we're going to talk about here. But I think more is coming. Like, this is the only way I can conceptualize the S&P getting behind this.
I do want to clarify just for the listeners, like it's not we've been saying this is a big win for Hyperliquid, and it is. And but the point I want to make, and it's important, is that it was actually Trade.xyz who got the license from SIP, and they use HIP3, and not to get bogged down into details, but this is kind of the beauty of the system. Hyperliquid is permissionless, so this separate entity from Hyperliquid, they're the ones who went out and licensed the S&P index from Standard and Poor's, and they are all licensed to trade it on Hyperliquid. They were, prior to this, they were already the dominant perpetual offer for real world assets on Hyperliquid, like something like 80-90% of volumes. So that obviously helped with them, negotiating these licenses. These tend to be like bespoke deals on compliance and revenue potential, whatnot. And so, theoretically speaking, another entity can also license it and launch it on S&P. But the second point I wanted to bring up was, it's after, these perpetual futures have no expiration date. That's the nature of them, as we know. But, they, after the market closes, they're no longer using S&P's direct feed. They go to the external oracle, and even before this licensing for real world assets, the oracle price is bounded. So even when markets are closed, unless like a weekend, the price can only move so much. And this is the reason for this is risk. It's a risk mitigation technique in case there's liquidations happen, in case there's an oracle failure. So yeah, those 2 points I wanted to clarify, because it's permissionless, but then still, there's still some semblance of regulation and risk management happening behind the scenes as well, which is, and in one side, this is the beauty about, decentralized applications, this permissionless nature that anybody can do it. And on the second side, it shows the maturity that the crypto industry is going through to also put the right systems in place to prevent any cascading fallout.
That's a great point. I think Trade is like kind of Hyperliquid's tokenization arm or RWA arm. I think it's kind of a subsidiary of their tokenization unit. So yeah, that's a very good point to make. And I think on the the S&P doesn't print 24/7 prices for obvious reasons. And I think honestly, this is a great start. This is a very, very good way to do this and kind of bridge the DeFi 24/7 world with the traditional 9:30 to 4 p.m. world on weekdays. Yeah,
just sounds ridiculous when you say it, David.
Insane.
Okay, nice. Michael, you brought up the SEC CFTC news that we also had this week. You want to kick us off?
Sure. So the SEC released this guidance that we all kind of anticipated was going to come out, but it's still groundbreaking nonetheless. So let me give the high level, and we can talk about it. So the SEC created a taxonomy of 5 categories of crypto assets, each with distinct legal treatment. So digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. And the entire document is built around sorting the crypto universe into these 5 buckets and explaining what the law requires for each one. My take is the most important category is digital commodities. I think that's the most groundbreaking piece of this. The SEC defines a digital commodity as a crypto asset that is, intrinsically linked to a functional crypto system, and derives its value from how that system operates and from supply and demand, not from the expectation of profits based on someone else's managerial efforts. And the SEC does something here that is never done before. It names specific tokens: Bitcoin, Ether, Solana, XRP, Cardano, I think Chainlink, Avalanche, Polkadot, which other ones? Dogecoin, Shiba Inu, Litecoin, a couple others, all named explicitly as digital commodities, not securities. So like for anyone who watched the prior SEC enforcement, the prior SEC enforcement actions, suggesting that Solana, Cardano, and others were securities, that position has now formally repudiated by this SEC. So that's a big one. The second major development is, I think, the treatment of investment contracts. So the SEC, it's not abandoning the Howey test, to be clear, But the commission's making this big distinction it had previously refused to make. The crypto asset itself is not the security. It's the investment contract around it that is the security. And the two can be separate. A token can be sold as part of an investment contract in its primary offering. The issuer will make representations about building a network, hitting milestones, delivering value, et cetera, et cetera. And at that stage, the offering needs to be registered. But once the issuer fulfills those representations, the token separates from the investment contract and it becomes not a security. And after that separation, the token can trade as a non-security in secondary markets. So under the prior enforcement regime, there was no clear path for a token to stop being treated as a security. The only guidance there was the Dow report in 2015, or 2016, where the Ethereum DAO, when it first launched, had this unregistered tokens offering, an ICO of ETH. They hit, the SEC came back a few years later and said, that was a securities offering, to be clear, but we're not going to enforce anything against you. We're not going to go after you. And people were sort of like, well, is that a securities offering? Is it no longer a security? I don't know. So now they're formally sort of declaring that securities can no longer be securities if they don't continue to have the proper indicia of a security, right? And what is that indicia, to be clear? What is like the main thing they're talking about? They're talking about the following: managerial efforts. And not just managerial efforts, essential managerial efforts. What does that mean? So unless the value of the token derives from the essential managerial efforts of the founders, that is not a security. The token is not a security. And they go into a lot of detail in this report about it. And so that is a huge clarification that we've all been asking for. I guess the last two things are.
But before you move on to that, I actually want some more clarity. You said managerial efforts of the founder, but what? And so that means if it's not the founder, those managerial efforts are okay, or any managerial efforts?
When I say founder, I mean, so typically it's called founders and promoters, right? So yes, the founders and promoters of the project. What I think this excludes now is like token holders promoting the token, and them being hit with regulatory enforcement actions. It used to be the case that if you were a big bag holder of a protocol and the SEC thought it was a security and you're promoting it, you're going to get lumped in as the promoters and as the founders, and therefore you're going to get hit with securities action. I think that is now very much no longer the case. And it's for two reasons. One, just the clarifications on the Howey test. But the second is that the SEC clarified in very perspicuous detail that network effects are no longer considered essential managerial efforts. Meaning, even if the founders or the promoters engage in activities that create network effects for the protocol or for the network, that those are not essential managerial efforts. So just on staking and mining, just real quick, they're saying staking and mining is outside of the securities laws. Just not securities. Staking is not a security. Mining is not security. And another one that went underreported here, I think, or not really talked about as much, is they went into wrapping of a token. And I'm sure Matt and David have dealt with this a lot, which is like explaining to their legal and compliance team, like, you can hold a wrapped token, but not, you can hold a wrapped token, which is the same thing as the token, except it's just wrapped a certain way so as to be able to be traded on a blockchain. The SEC has said that does not create a security. So that is actually big for DeFi because you need to wrap all of these tokens in order to trade it in DeFi. So I'll pause there, but very, very bullish news.
I also thought the liquid staking tokens, they also completely ruled that out as a security too, which some years ago, Matt, I used to work for CoinShares selling ETPs here in Europe. Well, a while ago, that was a big topic of discussion, whether liquid staking tokens were securities or not. And I didn't think staking was, but then I started to feel like maybe liquid staking was, but I'm glad that we finally got some clarity on that. But yeah, Matt, go ahead.
I was just gonna, I remember those sorts of debates as well. It is super helpful from a clarity perspective. I was gonna zoom out and talk about why this matters at like a 30,000 foot view. I don't know if that would be helpful, because I feel like all the conversation I see misses. It's almost like people imagine this as crypto picking a lane. It's either a commodity or a security, and like they think crypto wants to pick commodity because security is slightly more complicated, but it's way more existential than that, right? The core of securities law is that you have to have people come in and register and control the protocol and do disclosures and be liable for it. So decentralization is incompatible with being a security, right? It's not like it would be slightly more challenging to be a security, for Solana to be a security or Ethereum to be a security. It's actually that you can't be decentralized in a security. There's no, that those are square and round boxes. So this is like an existential challenge. And then why does it matter beyond the like challenges around trading, which I think people get hung up on? If it's unclear if you're a security or a commodity and you're an entrepreneur who wants to build something interesting, if you bet wrong, you are personally liable, not just at the corporate level, but down into your bank account and the home that you live in, for the losses that you may cause to people. And as a result, there's like a massive chilling of entrepreneurial energy, such that I think the scope of what crypto can do has been like contained 50, 60, 70%, because bold founders have looked at this and said, well, this would be cool, but if I do it, I'm going to lose my house. And that's not good. So it's really important, right? Before this, it was Bitcoin and maybe ETH. And ETH was maybe. And then everything else, entrepreneurs were taking enormous risk, or crypto literally couldn't exist because it couldn't be decentralized. That's like the scope. That's why I think this is so exciting. There are more micro reasons it's exciting, but I think we should make sure we note the big picture too.
This is absolutely awesome. Maybe I'm the one left with throwing a little bit of shade or talking about the non-solved issues. And make no mistake, this is a great development. On top of everything that Michael said, I mean, the fact that this interpretive guidance is coming from both the SEC and the CFTC, right? So this is already a reflection of both agencies talking about working together to move financial infrastructure forward. The fact that we got safe harbors, or very broad safe harbors around staking, mining, wrapping, airdrops, really, really positive stuff. I would say that most of what was there are things that the industry has been asking for a long time, for 5, 7, maybe 10 years. No one who's serious in the industry would dispute that a tokenized stock is a security. The fact that you're tokenizing a security maintains it as a security. So that's why we have the tokenized securities category. I think everybody would agree that this digital commodities category should exist. To be honest, I don't understand very well the separation between the NFTs and the utility NFTs. That was like very specific, very interesting to see, right? So like something like ENS that has utility is a digital tool, and something like CryptoPunks that is only a collectible is a digital collectible. So very interesting to see that they came up even with those types of distinctions. But the two things I want to highlight is, number one, this is guidance. So it's obviously very powerful. Obviously, the current SEC administration and the CFTC administration should be expected to abide by this as long as their tenures are around. But this doesn't carry the same force of legislation. This was a first step, and I think SEC Chairman Paul Atkins said it very nicely. He said, this is a bridge for the crypto market structure bill, for clarity. So they're kind of anticipating themselves a little bit towards that. But a lot of that and a lot of these things will be better enshrined once we have crypto market structure legislation in place. So let's not forget that the prize is still there. The big the big objective of having a crypto market structure bill. I think most folks would agree that the chance to get one is kind of 50-50. The window to close when everybody's going to be focused on the midterms is kind of coming here in a few months. So the crypto market structure bill remains extremely important, because I saw a lot of people saying that because these are topics that basically is a lot of what people have been asking for in the crypto market structure bill, it doesn't mean that the problem is solved. I think it would be very important to have these things enshrined. And the second topic, and perhaps the even more important one, is that and Mark and Michael talked a little bit about this before we started the recording, is that there is a very important category of assets that has not been addressed. And these are the revenue generating tokens. So like if you're Hyperliquid, if you are Aave, if you are Uniswap or Syrup, Morphos token. So if you are one of these tokens that are generating revenue, at least to me and to most folks I've spoken to, it is very unclear whether we can fit them in the digital commodities category or whether they're straight securities. There's question around fee switch. Like all these tokens I've mentioned, they have different fee switch kind of procedures, and they're in different stages of evolution. So I feel like that's the question that's still lingering. Unfortunately, these are some of the most interesting assets in the space right now. So if you talk to a lot of the smartest folks, from VC to momentum-driven hedge funds, a lot of the most interesting or a lot of their favorite positions are assets like Hype, are assets like Syrup, are assets like Aave or Uni. So again, Chairman Atkins put it very nicely, saying this is a first step and a bridge to the crypto market structure bill. And I think it doesn't mean that we have solved everything that needs to be solved within the crypto securities regulatory environment. It's a massive step. It's a very, very important first step. But we still have a few lingering questions that I think we'll be grappling with.
Yeah, I absolutely agree. I think the revenue producing fee switch question is notably absent, and probably because it's more complex. Like this stuff is all just a slam dunk. I will make one note on that. It reminds me just how gaslit we were by the previous regulator, that we're excited that the CFTC and SEC could actually cooperate on something. We're like, whoa, that's amazing. And we're excited that they could actually name Dogecoin as not a security. It is a reminder that like the world we're in now is actually the normal regulatory world. We were in some massive outlier crazy world where we couldn't even talk to each other between the two regulators, and we couldn't even make simple statements about what's a security and what's a commodity. We now at least have done 60 of the yards. There's still 40 to go, as David said, but we have made real progress, and we are in a more normal world than we were just a few years ago.
100%. And I would say we saw some of that in the market price section. It's very hard to untangle because there's just so much going on. And there was the SEC CFTC joint guidance. There was the Hyperliquid S&P 500 licensed perp announcement. On top of everything that's going on with macro that we don't need to repeat here, there's plenty of podcasts talking about what's going on with the price of oil and the FOMC meeting yesterday. So it's hard to untangle. But if you look at the price action of a lot of these revenue generating crypto tokens, they were relatively weak after that guidance came out. And I think maybe some of these folks, I wouldn't say they're disappointed because this is massive progress, but I guess these are questions that are still lingering. The exception here was Hyperliquid, and that might be because of the S&P 500 contract, or maybe, I don't know, something else. We never know. But it was interesting to see that playing out in the price action too.
I'll push back. And this is a little bit of a devil's advocate argument, but so I guess the question is like, what happens when a DeFi governance token like Uni, Aave, or Morpho, like that gives holders a share of protocol revenue? What happens? What is the status of that token? It does getting protocol revenue make it a security? And I can understand why people would be confused about this, because security, if you expect profits, you're a security, right? But we got to remember, it is profits that are derived from the essential managerial efforts of the promoters, of the founders, and of course, for Uni, for Morpho, for Aave, and for a lot of these other protocols, the fee switch, the revenue they generate is from the protocol. It is from the programmatic exercise of the smart contracts on chain. It is not from the managers. Let's compare the Uniswap fee switch and the revenue generation that you get by holding a Uniswap token to a public company deciding to issue dividends to its shareholders. What is the big difference between these two? Well, if you're a public company that decides to issue dividends to its shareholders, the board is voting on that, right? That is a decision that the board makes, and it is predicated by the managerial efforts of the board and the C-suite of the company. Compare that to Uniswap. Uniswap had a governance vote. The governance vote went in favor of the fee switch. And as a result, now the programs are upgraded and they programmatically distribute revenue according to the code. These are two very different models. And so I think, based on the narrowing of the essential managerial efforts definition in the SEC's guidance, I think it's pretty defensible to say that governance tokens that afford its users revenue streams is still not enough to be counted as a security. I will make one other point. The SEC was very clear that governance tokens in and of themselves are not securities. And if you think about that for 2 seconds, if a governance token is not a security and a governance token affords its holders the rights of governance over the protocol, and those holders vote to generate revenue and distribute revenue programmatically, how could that governance decision then turn what is effectively not a security into a security by virtue of distributing the revenue? So I actually think it's a pretty solid, I think the SEC was pretty solid in this.
I agree with you. But just to steel me on the other side and to present the reason I said it's more complex. Let's imagine that Uniswap Labs developed Uniswap and still had 98% of the tokens. And so the governance was only controlled by them. That definitely pushes you into a gray area if they decide to throw the fee switch, unthrow the fee switch, et cetera, because they have the dominant, the vast majority of share. That's why I meant it's like more nuanced. When you get in practicality, when you look at the token distribution of Uniswap and how the governance actually works, I agree with you that that's boots on the ground true. But I can abstract back to a world where just because it's a governance token, you have to do a little bit more analysis to think about how separate that is. And that's why I think it's like a little bit more nuanced. But I agree with you in principle.
And there's a spectrum here, right? So like even if you stay within DeFi, there's Maker on one side, and there's maybe Hyperliquid on the other, right? So like some of them look a lot more like centralized companies than others. And I guess the question is what are the guardrails? What are the important questions here and the important kind of metrics and concepts that will throw an asset on one category or another? I don't know. Interesting to see.
But at least now we can talk about it. You can't decide if Doge is a commodity, then like, what are we talking about here, right? Like, there's no way you're going to parse Hyperliquid and Uniswap. So we moved the ball forward.
We normally talk about saying the quiet part out loud, but I think they intentionally left it quiet for the SEC and their statement for the reasons I think. And I think that I don't think ownership should matter. I think control should matter. And there's a little bit of a distinction between them. But so, to your example, Matt, with the 98%, or Michael, when Uniswap made this vote, I voted, it is my vote on this centralized front end, automatically, programmatically linked to a blockchain, and then it already has some predetermined nature to change, to flip on a fee switch. Probably not, and definitely not for all protocols. It's more we, as the builders and founders of this protocol, wanted to put out a community vote, and they said that they wanted a fee switch. So we, with the controls over these keys, edited the code, whether it already had it built in or not, I think is irrelevant, edited this code to start to generate, to take some of that revenue cut. And if we were to say this, if this was a Robinhood example, where Robinhood didn't go to their board, but instead went out to their shareholders to vote. And Robinhood is a free tier model, right? And if they then put out a vote to should we start to take a fee? One is a security, one isn't, and then the other one you're saying is not a security just by definition because it's a digital asset. But I'm not really seeing distinction, and I agree it's very nuanced, especially with David's point with the Hyperliquid, because L1 is a commodity, but then they start to generate fees, and then Tempo has a DEX built into it, so it starts to get very blurred. But I want to ask all of you all this, and I'm sure you're going to have different answers to me. But if I had to be honest and ask, I don't want to name any particular protocol, but a lot of these revenue generating protocols, are they a commodity or are they a security? And I know it's more nuanced, but if I had to just choose one, I would lean towards security. And I don't like admitting that out loud.
But why?
Because to me, it seems like they have shareholders phrased as token holders, governance just framed as share voting framed as governance, revenue framed as fee switch. They have the same characteristics that I can relate to a regular security. And in fact, sometimes when I explain to my friends who are outside of crypto what this protocol does, I don't use the word token. I just say share. I don't use any of the crypto native words. I just replace the words, but the entire meaning stays the same, and then they understand it. But if I start to use crypto native terms, it becomes confusing. So just to summarize, why is because it just seems like it.
Seems like, yeah, sure. But I think we got to be really now very strict on when we talk about the conditions for a security. The SEC says in this guidance that it is the essential managerial efforts of others that would give a representation to users and to owners of a token that they can expect to make money. Does anyone think that Hayden, at the CEO of Uniswap Labs, it's his efforts that are essential to the fees generated by Uniswap on a day-to-day basis? I think the answer is no. But even if you think it is yes, there is a lot of guidance in the SEC's writings that say that actually the stuff that you probably think are essential managerial, that's actually administrative and ministerial, which is different, right? So operating a mining pool, SEC says it's administrative. Running validator nodes, administrative. Custodying staked assets, choosing node operators, administrative. Even running a liquid staking protocol that holds billions, picks validators, and issues liquid staking tokens, the SEC still treats that all as administrative. And so, if those things are administrative, surely what Hayden does and the Uniswap team by running a front end and holding a vote and doing a couple of other sort of tangential things that are tangential to the core protocol, that is also administrative. Even if it feels like that's somewhat similar to what a company would be doing.
Yeah, I think that's probably right, but I think the devils are still in the details. Certainly, crypto is not great about disclosing token distribution and ownership in a real-time way that people can trust. Certainly, we've seen examples of votes that happened and then were just ignored. The governance is not quite as buttoned down. You could argue that is fraudulent activity or something, right? I think there's a case to be made. So I agree with you, Mike. I just think the industry needs to mature a little, and we need to define these things, and we need to peg them down such that it's more formulaic than it has been in the past. Because certainly, if you look over the history of governance activities and token disclosures and things like that, there's definitely been some hands in the pie. Not always, but sometimes.
And listen, I'm playing devil's advocate here a little bit because I agree completely that you can take any good fact pattern in favor of non-security, change the slightest things about it, and all of a sudden it gets into the securities landscape. The securities laws were written, and the judges have interpreted the securities laws over the last almost 100 years to be broad and to not be restricted. There's not really many bright line rules, and the reason is because the moment you put a bright line rule in, securities issuers will figure out a way to just not do those bright line rule things to issue unregistered securities. And the courts know this. And so they've made these rules very flexible and malleable. That has good things for in many regards. It's also bad in a lot of other regards, especially as it relates to crypto, as we've seen over the last few years. So I completely agree. There's a lot of wood to chop here still, but I think as just a prima facie argument, like just at first blush, I think it is defensible to say that uni and other governance tokens would not be considered securities.
It's definitely progress. I'm happy that we're now going to start to tackle the more complex questions. I think great for the industry.
Yeah, I'm just gonna say that, if the Uniswap team left, I would assume that, like the Labs team, I would assume that the price of the token would go down. I feel like that's people basing their expectations on the price of work of the others, especially when they're upgrading code at V2, V3, V4. Doesn't seem like administrative to me. But again, I'm not an advocate of this. I'm playing devil's advocate, as a lot of us are. I'm sure there's a way to do it, maybe like with Burns or something. But yeah. I just want to end it off on any last thoughts you guys have, because we're coming up on time. There was one more topic I wanted to just mention. The staked ETH ETFs that are coming out. I don't know if Matt had any thoughts on that. I'm sure that's big news for you.
I think it's great. I think it's great. Look, it speaks to the continued progress that people are making. There have been some challenging questions around tax. That's actually what's held up staked ETFs more than anything else, is questions around tax. And it's good that we're making progress on them. The thing it reminds me of more than anything is that this crypto ETF journey is in its earliest days. And it's going to be 10x, 20x, 30x bigger than it is today eventually. So this is just, just imagine we're just getting to staked ETH, right? Just imagine the unlocks that are coming. So I think it's a big deal. I'm excited for it.
So on the tax question, like here in Europe, like if you have a Ethereum ETP, it like kind of reinvests. They call it coin entitlement. So it's not considered taxable because it doesn't actually distribute back to the ETP holder as a dividend. But is that the same thing with the US now, or?
I think you'll have to ask BlackRock that one. They have the staked ETH ETP.
Okay, fair. Okay, awesome. Any closing thoughts from anybody else?
DAS next week. Tune in.
Yes, thank you for doing my job. We will all be at DAS next week. We are actually going to be hosting the live podcast. First time we're all going to be together live in person. So if you're not coming to DAS, I don't know what you're doing. Especially if you're listening to this podcast, it's going to be the place to be. So I hope to see all of you there. You're can hit all of us up. So please, please, please come out.